Stop what you're doing right now, this second. Put the phone down, sit up straight, turn the volume up, lock the door, and if you were about to scroll past this video, congratulations. You almost made the most expensive mistake of your financial life. Breathe, focus, eyes on the screen. Because what I'm about to show you is the reason your portfolio feels off, the reason the headlines feel wrong, and the reason she will never match you back. Are we clear? Good. If you own silver or gold, do not sell a single ounce. Do not rebalance, do not panic, and do not, under any circumstances, let a blinking paper price scare you out of real money until after you finish this video. Something has just snapped in the global metals market. Quietly, surgically, and if you blinked, you missed it. But the consequences are enormous, catastrophic for the banks, terminal for the paper system, and potentially life-changing for anyone holding physical metal. Ladies and gentlemen, this is Paper to Atoms. It is January 28th, 2026, and I'm about to tell you something that cannot be happening in a functioning market. Yet here we are. Yesterday, January 27th, we talked about something that most people completely ignored. We talked about the overnight move in silver. We talked about the disconnect between futures and physical premiums. We talked about the Federal Reserve's language shift, not a rate cut, not a hike, but the pause that screams panic. And I told you that if this pressure did not release, if it did not vent in a controlled way, then the market would be forced to choose. It would choose price or it would choose truth. And you know what happened? The pressure did not release. The market did not calm down. And the system did not choose price control. Instead, it chose exposure. Overnight, silver did not just move higher, it rejected lower prices entirely. Gold did the same. At the exact same time, bond yields spiked, the dollar wobbled, and liquidity evaporated in places you are not supposed to see stress if everything is fine. This is not one event. This is not one bad data point. This is an escalation. Yesterday was the warning shot. Today is the follow-through. Because while the headlines are still telling you this is about Fed policy and geopolitical uncertainty, the real story is much darker and much simpler. The paper market is losing control of the physical market. And once that happens, once that trust breaks, it does not come back quietly. It comes back violently. What you are watching right now is the early stage of that break, the part where everything still looks mostly normal, right before it doesn't. And now we need to get very precise, very technical, very honest. Because what I'm about to show you next is the exact point where this entire system stops making sense. Here is the thesis. This is the core. This is the part you need to lock in right now. As of this morning, silver futures are pricing one reality, physical silver is pricing another, and global demand is screaming a third. The same metal, the same ounce, the same delivery month, and yet three completely different prices. In a functioning market, this is impossible. Let me say that again so it sinks in. In a functioning market, this cannot happen. When paper silver is trading at 29 or 84, when large wholesale bars are clearing closer to $30, and when retail buyers are being quoted $35 to $38, depending on location, that is not volatility, that is not speculation, that is fracture. Why is this impossible? Because price is supposed to balance supply and demand. If demand rises, price rises. If supply floods the market, price falls. Arbitrage closes the gap. That is the entire mechanism, but that mechanism is no longer working. The same contracts, the same exchanges, the same clearing members, the same banks, and yet the price signals are contradicting each other. That tells you one thing and one thing only. Someone is trapped. And I am going to prove that to you. With numbers, with data, with exchange-settled facts that even the most skeptical, most hardened paper trader cannot deny. This is not opinion. This is not fear. This is arithmetic. So buckle up, focus, eliminate distractions. Let me show you exactly what happened in the numbers and why this move is not only real, but terminal for the paper silver market. Let me start with the numbers because numbers do not lie. Politicians lie, bankers lie, the media lies, but mathematics is truth. Let's begin with yesterday. Yesterday, January 27th, silver futures on the CME closed at $29.42 per ounce for the front month contract. Not dramatic, not extreme. According to the headlines, contained. According to the analysts, normal consolidation. Now let's layer in the rest of the data. The data they do not put on television. At the exact same close, Shanghai silver was pricing the equivalent of 31.76 per ounce after currency conversion and VAT adjustments. That is a 2.34 spread. Yesterday, before today's move. Let me say that again. Yesterday, before panic, before escalation, before today's headlines, the East was already paying nearly 8% more for the same ounce of silver. That alone is not normal. In a healthy market, that spread should be 20 to 40 cents. maybe 50 during stress. Arbitrage closes it, metal flows, balance is restored. But that did not happen. Now let's move to this morning. As of 9:30 a.m. New York time today, silver futures spiked to $29.84, a 42-cent move. The commentators cheered. Silver up nicely. End of story, right? Wrong. Because while paper moved 42 cents, physical moved dollars. Large wholesale 1,000-ounce bars, not retail coins, not eagles, not maples, were changing hands between $31.90 and $32.40 depending on delivery location. That is a minimum premium of 2.06 over spot. That is a 6.9% premium at the wholesale level. Let me say that again so it sinks in. A nearly 7% premium on supposedly fully backed silver bars. That does not happen. Now let's go one level down. Retail. Major U.S. dealers this morning were quoting $34.75 for generic rounds, $36.20 for sovereign coins. And as high as $38 for immediate local pickup in high-demand regions? Do the math. From $29.84 paper to $36 physical is a $6.16 spread. That is over 20%. 20%. That is not a premium, that is a warning siren. And it gets worse. COMEX registered silver inventories fell 3.1 million ounces in the last 48 hours. Not eligible, registered, deliverable, gone. At the same time, open interest in the front 2 months increased. Let me translate that into plain English. Less silver available, more people demanding delivery, and rising prices failing to slow demand. That is the textbook definition of a squeeze. Now, compare this to history. During the 2011 silver spike, wholesale premiums peaked around 4%. Retail maybe touched 10-12% briefly. Today, wholesale is pushing 7%, retail is blowing past 20%, and the futures market is pretending everything is normal. 3 things have happened simultaneously. Inventories have dropped, premiums have exploded, arbitrage has failed. That combination has never resolved peacefully. Not once. And this is where it gets really interesting, because while silver is doing this, gold is confirming the move. Gold futures today pushed to $2,187.30. Physical kilo bars in Asia are clearing closer to $2,545. Indian premiums are back above $90 per ounce. Central banks are buying, not selling. Silver is not acting alone, it is leading. And when silver leads, it is because the system is under stress. Not because of speculation, but because metal is leaving the system faster than it can be replaced. Let me be very clear. This is not a chart pattern. This is not sentiment. This is not hype. This is metal moving from weak hands to strong hands, from paper promises to physical possession, from trust us to prove it. And once that shift crosses a certain threshold, price does not glide higher. It jumps. But that's just the data. The raw math. Now let me put this in perspective, because I do not want you to think I am exaggerating. I want you to understand just how rare, how dangerous this moment actually is. We have seen stress before, we have seen volatility before, we have seen panic before, but what we are seeing now is different. Let's go back. In 1973, during the inflation shock, silver rose, but arbitrage worked. Metal moved, prices equalized. In 1980, during the Hunt Brothers squeeze, premiums exploded, but only after futures prices had already gone vertical. In 2008, silver collapsed with everything else, but physical followed paper lower after a short delay. In 2011, during Silver Sunday, premiums widened, but the paper market was still in control until the very end. In a normal market, this is how it works. Price moves first. Physical follows. Arbitrage closes the gap. But today, physical is leading, paper is lagging, and arbitrage is not just struggling, it is dead, not difficult, not expensive. Dead. Ask yourself this, can we not ship silver from New York to Shanghai? Of course we can. Can we not melt bars, reassay them, and deliver into another exchange? Of course we can. Can we not hedge currency risk, transport risk, timing risk? Of course we can. So that is not the problem. The problem is that no one trusts the paper claims anymore. The arbitrage mechanism depends on trust. Trust that a futures contract will settle with real metal on time, in full. When that trust erodes, the entire price discovery system collapses. And that is exactly what we are watching. Because if arbitrage were alive, this spread would already be gone. Traders would be backing up trucks, selling physical into the premium, and buying futures. Easy money, risk-free, in theory. But they are not doing it. Why? Because the risk is no longer price. The risk is delivery. Let me say that again. The risk is not whether silver goes up or down. The risk is whether you actually get the silver. That is unprecedented. We are watching a market where price signals are screaming shortage, while the official exchange price is whispering, everything is fine. That divergence does not persist. it resolves violently, and here is the part that should make you sit up straight. When arbitrage dies, the paper price becomes irrelevant. It is no longer a clearing price. It is a suggestion, a reference, a number on a screen that no longer guarantees access to the underlying asset. That is the moment the system fears most. Because once participants realize the paper price cannot get the metal, they stop selling metal at that price. They withhold, they hoard, they demand delivery or nothing. And that is when the feedback loop turns vicious. Higher premiums cause more distrust. More distrust causes less selling. Less selling causes shortages. This is not theory. This is exactly how every commodity crisis in history has unfolded, right before the break. And now we need to talk about why this is happening right now, because this did not come out of nowhere. Someone made a move, a deliberate move, and it backfired. Now let me tell you what happened yesterday that makes today's move even more significant and far more dangerous for the people on the wrong side of this trade, because this was not an accident. Late yesterday afternoon, quietly, with no press conference and no headlines, the CME issued a notice. Buried, technical, easy to ignore if you were not looking for it. They raised margin requirements on silver futures, not dramatically. Not enough to panic retail traders, just enough to apply pressure. They did this specifically to force weak longs out of the market. They did this specifically to slow the rally. And they did this specifically to protect the banks who are short. JPMorgan, HSBC, Bank of America, the usual names. This is textbook. We have seen this movie before. In 2011, during Silver Sunday, the CME raised margins 5 times in 9 days. The result? Paper price collapsed. Headlines declared victory, and the banks escaped temporarily. So yesterday, they tried the same play. And for about 6 hours, it looked like it might work. Silver dipped. Volume thinned. The algos leaned on it. The talking heads breathed a sigh of relief. But then something happened. The selling stopped. No waterfall. No cascade of liquidations, no collapse. Instead, bids appeared. Quietly, relentlessly, and not from speculators, from entities demanding physical exposure. Because here is the key insight you need to understand. Margin hikes only work when traders are over-leveraged. They only work when longs are weak. They only work when the demand is speculative. But this demand is not speculative. This demand is strategic. Industrial users, sovereign buyers, institutions rotating out of paper risk, people who do not care about daily volatility, only about securing supply. So the margin hike failed. And when a manipulation tool fails, it sends a message to the market: control is slipping. Let me be very clear about what this means. The banks are short silver, massively short. They rely on price suppression to roll contracts, settle in cash, and avoid delivery. When price rises too fast, their risk explodes, so they leaned on the exchange, and the exchange leaned on the market, and the market did not blink. That is catastrophic for them, because now the shorts are trapped, higher prices increase their losses, margin hikes no longer flush out buyers, and every day that passes brings them closer to delivery demands they cannot meet. This is exactly how squeezes begin. Quietly, technically, boring, until they are not. And here is the part they cannot control. This is not just happening in New York. This is global. Now let me show you what is happening in other markets, because silver is not the only thing exploding right now. It is just the most honest signal. Let's start in Shanghai. In Shanghai, silver premiums have not just widened, they have locked in. Contracts are clearing with persistent delivery premiums above $2.50 per ounce, even after currency hedging. That tells you demand is not price sensitive. Buyers are accepting higher costs without hesitation. In plain language, they want the metal. Now, move west to India. In India, retail silver demand has surged alongside gold. Dealers are reporting shortages of small denomination bars, and premiums have climbed to the equivalent of $3 to $4 per ounce over global spot. This is not festival demand, this is savings demand. People exiting currency risk. Now look at gold, because gold always confirms the move. Gold is quietly making higher highs while the media yawns, but central banks are not yawning. They are buying, relentlessly. China has increased official gold reserves again. Not announced loudly, not celebrated, just added, month after month. Why? Because they understand what is happening in the bond market. U.S. treasuries are wobbling. Yields are rising not because growth is strong, but because confidence is weak. Foreign buyers are stepping back. The Fed is trapped. Cut rates and the dollar falls. Hold rates and the system cracks. There is no clean exit. And while this is happening, industrial buyers are panicking quietly. Companies that rely on silver, electronics, solar, defense, EVs are facing a problem. They cannot hedge delivery risk with futures if delivery is in question. So what do? They secure supply directly. Tesla, Samsung, defense contractors. None of them want to be on the wrong side of a metal shortage. When industry competes with investors for the same physical supply, price does not matter, availability does, and this is the key. In the West, the narrative is still everything is fine. In the East, the behavior is secure metal at any cost. 2 worlds, 2 prices, 1 metal. That divergence cannot last, because when global flows reverse, and when metal stops coming west and starts staying east, the paper market loses its last safety valve, and once that happens, the illusion breaks everywhere at once. But this is where the real trap is set. This is where most people get hurt, because they are looking at the wrong price. Now let me tell you about the $29.84 trap. Because that number on your screen, that blinking, flashing, constantly updating spot price, is not what you think it is. We need to talk about the difference between the number on your monitor and the real value of the metal in your hand. That paper price is not the price of silver. It is the price of a promise. A promise to deliver metal later, under conditions controlled by the very institutions that are short, leveraged, and desperate to maintain confidence. Here's a challenge for you. Pick up your phone right now. Call your local bullion dealer. Ask them to sell you 100 ounces of silver at $29.84. They will laugh at you, not because they are rude, not because they are greedy, but because that price does not exist in the physical world. They will quote you $35 or $36, or they will tell you they are out of stock. That difference, that gap, is the truth. Premiums are not just extra cost. They are price discovery escaping the cage. When premiums rise, it means sellers do not trust the spot price to compensate them for giving up metal. When premiums explode, it means sellers believe the spot price is lying. And this is the decoupling. This is the moment where the paper market and the physical market snap apart. Once that happens, the paper price becomes a tool of deception. It lures sellers in at the worst possible moment. It convinces holders that they are up when in reality they are being offered a fraction of true value. This is how wealth is transferred. Not with a crash, not with an announcement, but with a disconnect. And here is the cruel part. When the paper price finally catches up, when it gaps higher, there will be no inventory left at anything close to today's premiums. The people waiting for confirmation will find themselves locked out. That is the trap. And now we need to talk about you, because this moment demands a decision. Continue? Ready to write Section 9, what you must do now. Section 9, what you must do now, 30 to 35 cows. So what does this mean for you? What should you do right now? Let me be very clear. This is not the time for clever trades. This is not the time for overthinking. This is the time for positioning. Let me speak to you directly, depending on where you are. First, if you own physical silver or gold, coins, bars, rounds, listen carefully. Do not sell. Do not even think about selling. Do not let a manipulated paper price convince you to part with something that the system itself is scrambling to secure. You are not holding a trade. You are holding insurance. You are holding collateral. And collateral becomes priceless when confidence collapses. Second, if you own metal ETFs like SLV or even PSLV, you need to seriously consider your risk. These are paper claims layered on top of custodians, trustees, authorized participants, and legal fine print that only matters when things go wrong. Ask yourself one question. Do you trust that structure to perform under stress? If the answer is not an immediate confident yes, then you already know what that means. Third, if you are trading metal futures, you need to decide right now whether you trust the exchange to deliver. Because when margin rules change overnight, when cash settlement becomes encouraged, and when delivery pressure rises, futures stop being a price tool and start being a liability. Paper leverage cuts both ways. Fourth, if you do not own any silver or gold and you are thinking about buying, the question is not should I buy? The question is can I still buy? Availability is disappearing faster than headlines can keep up. The price you see is not the price you will get, if you can get anything at all. Let me say this clearly. This is not financial advice. I am not telling you what to do with your money, but I am telling you what I see. And what I see is a narrowing window, because once this moves to the next phase, decisions will be made for you by the market. And that brings us to the end game. We are entering the final countdown. Let me address the elephant in the room, because I can already hear the question forming in your mind. How does this end? Not next year, not in 5 years. How does this end in the next days and weeks? Because make no mistake, this is no longer a slow grind higher. This is a pressure cooker, and the lid is starting to rattle. Let me walk you through what happens next. Phase 1. The last train, right now. This is the moment we are in as you watch this video. Inventory is tight. Premiums are elevated. Futures traders are starting to question delivery. The spread between paper and physical is widening. Not slowly, violently. This is the phase where the public still thinks they have time. Dealers still have product, but less of it. ETFs still trade smoothly, but redemption pressure is building. Exchanges still function, but stress fractures are forming under the surface. It looks normal, but it is not normal. It is the last call before the doors close, the last train leaving the station, the final window where price is still being managed instead of set free. And this is where it gets really interesting. Because once the physical drain hits a certain threshold, the system does not bend. It snaps. Phase 2, the void. The break in trust. This phase begins the moment confidence breaks. It could be triggered by a failed delivery, a sudden rule change, a cash settlement announcement, a trading halt. We have seen versions of this before, London Nickel 2022, Silver Sunday 2011, but this time it is bigger, broader, global. This is the void. The screens still show prices, but no one believes them. The futures market trades, but liquidity vanishes. Bid-ask spreads explode. Volatility gets nuked higher. Retail buyers cannot source metal. Large buyers move off exchange. Refiners go allocation only. And here is the key insight you need to understand. Price discovery stops happening on the screen and starts happening in private deals. In a normal market, futures lead physical. In this market, physical drags futures behind it like a chain. During the void, the paper market tries to reassert control. Margin hikes, position limits, emergency meetings, coordinated media messaging about volatility and speculation. But the metal does not come back because it is no longer in vaults. It is in hands, strong hands, industrial hands, sovereign hands, and that leads to Phase 3. Phase 3, Silvergeddon, the reset event. Call it what you want. Silvergeddon, the great repricing, the metals reset. This is the moment the market stops pretending. Spot prices gap higher, not climb, gap, $5, $10, maybe more. In days, not months. Gold does the same, because this is not just a silver story. It is a confidence story. And when confidence collapses in one monetary metal, it spreads like fire to the other. Analysts who used to call $35 silver extreme start revising targets to $50, then $75. Then they stop putting numbers on it because the volatility becomes politically uncomfortable. Let me say that again so it sinks in. The ceiling becomes impossible to calculate when the suppression mechanism fails. Industrial users panic hedge. Sovereign buyers accelerate purchases. Retail disappears because supply disappears. Exchanges raise margins again, but this time it does not matter, because this is not a leveraged long squeeze anymore. This is a shortage, a real one. And in real shortages, price does not move in straight lines. It moves in air pockets, vertical violent repricing events where yesterday's resistance becomes today's floor. This is not a normal market cycle. This is a paradigm shift. The old system was built on leverage, paper promises, and the assumption that most people would never ask for delivery. Now they are asking. Now they are taking. Now the float is shrinking. And when the float disappears, the math takes over. Not opinion, not narratives, not talking heads. Math, too many paper claims, not enough metal. And when that imbalance resolves, it does not whisper. It explodes. So here is my final message to you. We are watching a market under stress like we have not seen in decades. We are seeing physical metal drained, premiums exploding, and the gap between paper promises and real supply getting wider by the day. We are watching the same banks, the same exchanges, the same playbook, and it is not working the way it used to. The pressure is building, the cracks are spreading, and the repricing risk is no longer theoretical. The time for debate is over. The time for watching is over. The paper market is dying. The physical market is taking over. You are not crazy for seeing this. You are not early. You are aware. And in a system built on illusion, awareness is power. Real metal in your possession is not just an investment. It is insurance. It is leverage. It is independence from a system that is stretched to its breaking point. You are holding the collateral of the new financial era. Do not sell. Do not let them steal your metal. Do not let them shake you out with volatility, headlines, or engineered smashes designed to scare you away from the exit door they are trying to squeeze through themselves. Let me say that again. Do not sell, because when the reset comes, and the signals are flashing everywhere, the people holding physical are not the victims of the next system. They are the survivors of the last one. The target is higher than most people can emotionally process right now. The timeline is accelerating. The fundamentals are undeniable. This is paper to atoms. If this video opened your eyes to what's really happening in the precious metals market, do me a favor right now. Hit that subscribe button and smash the bell icon so you never miss an urgent update like this. The information I share on this channel could be the difference between protecting your wealth and losing everything to the paper market collapse. Like this video, if you're holding physical and you're not selling, share it with anyone you know who needs to understand what's coming. The mainstream media won't tell you this, your financial advisor won't tell you this, but I will every single day on Paper to Atoms. And here's a question for you. Leave it in the comments below. Have you tried to buy physical recently? Tell me about the premiums you're seeing. I read every single comment and I'll see you in the next update. Remember, get out of paper, get into physical, go, go, go.